Hello guys and welcome back to another video of me, Pascal. Today I'm going to talk about something that has been occurring a lot in the news recently, and it's been about the GameStop stock. So if you don't know what happened, I'm going to do a short introduction and go through what really happened to the stock. If you already know what happened and just know why the GameStop stock went up so much, you can just scroll because I will have timestamps in this video, which are basically small spaces between different parts. So this is the introduction basically, and you can just scroll to the next part. So yeah, let's get started. So as you can see, GameStop stock went up from $5 to $25 and then continued to over $300. And look how fast this increase was happening. It was really fast. So it just went up like crazy. So first it has been traded kind of sideways and going down, and then it just shot up, went back, and like this. So what is really happening to the stock? So the event that is occurring or have occurred is called a short squeeze. So I will just write it down, short squeeze. So what is a short squeeze? A short squeeze is when a group of investors or traders or whatever you want to call them go together and decide to buy a stock because it's shorted a lot. So why is this a good idea or a bad idea? I'll go through now. So when a company thinks that a company they want to trade will go down, they basically enter a short position. And a short position is basically, they basically put money that the stock will go down, and if the stock goes down, they make a profit. If the stock instead goes up, they lose money. So that's basically the definition of what a short seller is. So how do they actually sell the stock, you might ask, on a technical level, and how can you sell something that you don't own? So this is how it works. So if we have, let's call him Ben. We have Ben over here. Ben is bought the stock, and in this example GME. So Ben bought the stock, and what happened is that Ben goes to a brokerage account, basically a bank or just broker, which basically is the middleman between you and the markets. So what the broker then does is they have the shares that Ben owns. Then what they do is they have a short seller, let's say right here. And what the short seller does, it is go to the broker and enter the short position. So you have Ben that bought the stock, and you have the short seller who wants to bet against the stock. So what they do is Ben borrows the stock to the short seller. So he basically borrows the stock. Ben actually a lot of the times doesn't even know that he's borrowing the stock. But yeah, the broker can give him back the stock if he wants to withdraw, because they have a lot of stock maybe, or like they have other people that have stocks, and they can basically pay back Ben in case of a sell. So he doesn't really have to know that they are lending out his stock to one of these short sellers. So I will just write her, let's call him John, short seller. So what happens is, if John wants to take profit or take a loss, he has to give the stock back to Ben, or basically to the brokerage, who then gives it back to Ben. So if for example he is down $100 and doesn't feel like he wants to lose more, or he doesn't think he thinks the stock will go up and he will lose money, he can basically buy it back. So this is really important to know. Buyback. So the only way Ben can sell his stock is if he buys back the stock. That's his only way to exit the trade. So this is really important for the GME stock. So he has to buy back to get his money, and if he doesn't buy back, he won't get his money. So that's basically it. So what happened in a short squeeze is, I will just delete this really quick, was people realized that GME was shorted a lot, actually over 100%. So more of the stock were shorted than the actual stock amount, and this is freaking crazy, guys. So imagine that the stock is, I don't know how to, like, let's say the stock is this. The stock was basically shorted more than people that bought the stock. So yeah, it's crazy. So it's hard to explain how this works, but basically they short their own short position. Yeah, they short their own short positions, kinda. So I will not go in depth on that, but it was over 100%. And if I'm correct, it was actually around 130% to 140%. I think it was 130% if I'm correct. So around 130 beginning. So at the beginning of the basically before the short squeeze, it was around 130% shorted. So what the Wall Street Bets, basically the group of people that, I wouldn't say pumped up the stock, but yeah, wanted to buy the stock because yeah, they like the company, and yeah. So what they decided to do is they were gonna, literally, I'm not gonna swear because this is a YouTube video and I try to be family friendly, but they basically tried to F over the hedge funds, and the biggest short positions were the hedge funds. So the ones that shorted the most was hedge funds. And you have probably already heard about the financial crisis, but I will get into that a bit more later on how it's connected. So they wanted the hedge funds to lose, and they wanted to benefit from it, and they wanted just to like basically fight the hedge funds. So what happened was they got together as a group of people and decided, yeah, let's go, we're gonna buy this stock. And if you haven't seen Reddit, so I will just, I don't have to show it right now, but it has like over, I'm gonna check on my phone really quick. So the Wall Street Bets, basically, I think it has over 8.7 million members right now, and I think it has around 3-4 million something at around the middle of this, and it had 2 million before. I'm not 100% sure, but I think it was around that amount. So they decided, we will go together and buy the stock, basically push the stock price up. And what happened was the hedge funds had a really hard time trying to get out of their positions, and they didn't want to lose money, obviously. So what the Wall Street Bets did was they kept pushing the price to insane amounts, new high each time, making the hedge funds that shorted the stock basically lose millions because it didn't go down, or even billions of dollars. So yeah, that's pretty much it. But there were some other factors, because if you don't know, you might say, oh, it's so obvious, it went down a lot now. You can see it's at $66 and it was at 350, around that, 400, 350 at the highs. So you might say the hedge funds are professional. They probably know that such an unexpected move in the stock price will make the stock go down later after the push. So yeah, the hedge funds aren't stupid. They know this. So why did a lot of them exit their positions? They didn't do it like because they wanted to. They got something called margin called. So basically, if you don't know what margin is, it's basically when you basically borrow money from the stockbroker. So pretty much they borrowed money from the stockbroker to keep their positions, because they were down so much money, so they even had to borrow money. So if example, the stock goes down 10%, you obviously lose 10%. But imagine the stock can only go down a certain amount of money. The stock can go down like just to its $0 basically. So if you have a $10 stock, it can only go down to 0. But guess what? If you have a $10 stock at a buy, it can go up infinite amount. It can go up like infinity. Like it can just keep going up. Okay, I'm gonna show you. If you see, it can go from $10 to $100, and it can go from $100 to $1,000, and from it can just keep moving up. That doesn't mean it has to move up, but it can. So if it can go up infinity amount, pretty much, and it can only go down a set amount. So when it was up a lot of money, it actually went up. So many of the hedge funds didn't have enough money in their accounts to cover the losses, and some of them didn't even have the possibility to borrow money from their broker. Some had. I'm not sure which brokers allowed it, but basically what happened was they were down so much money that they couldn't pay for basically the loss of value. So the broker forced them to close their positions, and it was really bad for the hedge funds. So I'm gonna just... So basically, if it goes up like this, they entered right there, maybe at let's say they entered at $25. It was at $5. They were in a profit. They made money, and when it went up and they had to close at 350, or let's say they had to close at 250, it was because they didn't have money to pay for the losses. And yeah, that's pretty much it. So that's why they didn't keep going. Maybe some hedge funds did keep going, but yeah, a lot of them got margin called basically. And why did this happen to GameStop exactly? It was, as I said before, because it was shorted so much. But why did they short it? You probably know that games have been a lot of digital right now. You have Steam, PlayStation Store, and you don't really go to stores anymore, and it's COVID-19. People just don't buy games from stores that much. They buy them digitally and download the games. So it was a brick and mortar business, and it was Netflix and Blockbuster. Blockbuster lost tons of money, and then I'm pretty sure they went out of business because Netflix basically made it so much easier for them to watch movies for their clients. So it's an old business model which isn't really that nuanced, and it's in this digital age. I probably bought my last physical game 4 or 5 years ago, and I just buy them digitally right now. It's cheaper. Most of the time it's easier. You don't have to go to the store, and in COVID-19 times it's safer. So that's why many believe the stock would go down. But this hedge fund did illegal stuff. Kinda. I'm not gonna... Actually, that's my opinion. That they might have done. My opinion is that they might have done illegal stuff. I don't wanna... I'm not a legal professional, so I'm not gonna say anything about that. But when many hedge funds believe that the price will go down, they do exactly what Wall Street Bets did. They go together as a group, short the stock because they believe it will go down, but they do it with so much money that it actually pushes the price down even more. So they just kept pushing the price down, made tons of money, and basically the ones that owned GameStop and was buyers lost tons of money. And Wall Street Bets felt like these morons from the hedge funds are just dumb, and we don't want them to benefit from manipulating the stock market. They posted all bad reports, like news and stuff, and basically they made tons of money shorting it. So Wall Street Bets felt they have an unfair advantage. We are going to do the same thing as retail investors and get together and just show them that we can also make money, and we will just lose you tons of money. So what basically happened, or I will just do like this. Why is it has with the financial crisis? Why does it has anything to do with the financial crisis? So in the financial crisis, the government most of the time bailed out the hedge funds. Basically, the hedge funds were going down because of, yeah, basically the whole financial industry was crashing down in 2008 and 2009. So it was just going down. You probably already know this. But the hedge funds got money from the government to keep going. There are some examples of when this didn't happen, like for Lehman Brothers, but a lot of hedge funds went bankrupt, and yeah, that's pretty much it. Not a lot of hedge funds went bankrupt. Sorry, I said a mistake, but some hedge funds went bankrupt, like Lehman Brothers, but most of them got bailed out, or a lot of them got it. So they got money to the government to sustain their business and keep going, because yeah, they made tons of money, they paid taxes on that money, so the government benefited from it. The hedge funds were happy because they didn't go out of business, and the retail investor, what bailout did they get? What bailout did like millions of people that were investing in stocks and lost all their savings get? They got $0 from the government, and this is why they are mad at the financial crisis and how the hedge funds got bailouts. So they basically want to get a payback for that. So that's pretty much what happened to GameStop and its effect on the stock market. So the future. So in the future, they will probably happen. This will probably most likely happen again. So if you want to be, I'm not suggesting this. If you want to do your own research, don't blindly follow stock tips. But if you want to read for fun and maybe see some stuff, you can go into the Wall Street Bets Reddit forum basically and check out what is happening over there, because that's basically the ones that got together. So I think this will happen a lot more in the future, so stay up with the news and stuff. And I think the hedge funds will be a lot more careful about shorting, because if they short a stock too much, Wall Street Bets will see it, and yeah, they might even fight back even harder than I did with GameStop. So that's pretty much it for this video. Hope you enjoy it. If you did, please smash that like button, subscribe to my channel, and comment down below if you have any video suggestions. So yeah, see you in another video.